I'm David Cariani and welcome to the RFA Weekly Market Update. Markets gave up over 3% this week, and it's been a couple of years since we've seen a week like this, but it's actually more normal than the excessively smooth ride that we've had over the last year and a quarter. Even after this drop, we still have an exceptional start to the year, 1 month in and still over 3% gain. We're going to take a look at some of the mini earnings reports that came in this week, but first let's take a closer look at this week's market results. We had all U.S. stocks dropping over 3.5% so far on the week, and international stocks only down about 1.5%. U.S. government bond yields soaring to 2.84%, up nearly 20 basis points on the week, and mortgage rates approaching 4.25%. While the dollar was little changed this week, crude oil gave up 1% of its recent run. And in economic data this week, we had jobless claims come in little changed from last week's reading at 230,000. And then we had jobs created in the month of January up to 200,000. The unemployment rate held steady at 4.1%, and average hourly earnings starting to climb, an increase of 2.9% from a year ago. We had consumer confidence spiking up to 125, and the Fed funds rate was held steady at 1.5% after the Fed's meeting on Wednesday. But they did reaffirm their view of 3 rate increases later this year, which has contributed to the uptick in bond rates this past week. And now that we're halfway through earnings season, we're going to take a quick look at how it's shaping up thus far. So you can see from this graphic on the top left that 251 of the S&P 500 companies have already reported, and the biggest disappointment has come from the energy sector, with earnings coming in about 13% below expectations. And the biggest positive surprise has come from the materials sector, with earnings coming in 11% above expectations. And the top line represents the S&P 500 as a whole, showing that earnings overall have been 3% above expectations. And in portfolio-related news, this week Lockheed Martin reported earnings of $4.30, which was 6% above expectations of $4.06, on revenue of $15.1 billion, which was 3% ahead of expectations. Over the next few years, they will be doubling production of the F-35, which represents over a quarter of their sales. And profit margins are expected to increase with the added scale. The company also has the tailwind of increasing defense spending globally, and their tax rate will drop about 9% due to the new tax law. The stock is up 3% for the week, even after today's sharp drop. And then PayPal reported earnings per share of 55 cents, which was 3 cents above expectations, on revenue of $3.7 billion, which was 3% ahead of estimates. Their number of accounts grew by 15% last year, and their revenue grew by 20%. However, former parent company eBay announced that they will be switching providers in 2020 at the expiration of their corporate separation agreement. This likelihood was already built into PayPal's financial forecast, but the news still triggered a 9% drop in the stock this week, which still holds on to a 4% gain year to date. And HCA Healthcare, the hospital operator, reported earnings per share of $1.30, well below estimates of $1.87, on revenue of $11.6 billion, which was 3% above expectations. The company announced planned capital spending of about $10.5 billion over the next 3 years to help them gain market share and pricing power with big payers. Their tax rate is expected to improve by 5%, and revenue to grow by 5% in 2018. The stock is up roughly 3% for the week. And today, ExxonMobil reported earnings per share of 88 cents, missing the estimates of $1.03, on revenue of $66.5 billion for the quarter, which was 7% below expectations. The Q4 numbers were disappointing, but were a result of a shift in their strategy. They've been adjusting their portfolio to hold more low-cost resources to adapt to the relative permanence of the new lower commodity prices. the fruits are expected to be seen starting in 2018. The stock is down 6% as a result, erasing its gain year to date. And next week will be light on economic data, but earnings reports will continue to pour in. We'll cover the highlights from those as well as check in on progress of the season overall. But that's it for now. Thanks for watching. We hope you can join us again next week.